Welcome to The Deep Dive, the show where we cut through the noise and get straight to the vital signals from corporate earnings calls.
Great to be here.
Today, we're taking a deep dive into the second quarter 2025 results and the management commentary from FB Financial Corporation, that's ticker FBK. They're the regional banker operating FirstBank across the Mid-South.
And this call, well, it had quite a few moving pieces, didn't it? And the market certainly had a strong reaction right out of the gate.
It really did. Fascinating quarter, lots to unpack. And you're right, that market red was pretty clear initially, but there's definitely more beneath the surface here.
Absolutely. We saw, a mix, some strong underlying performance, but also this significant one-time impact that really skewed the reported figures.
Okay, so let's jump right in with the top line numbers. The overall sentiment, well, it was a mixed bag, maybe putting it mildly. The company reported revenue of $76.9 million. That was a huge miss against the consensus forecast, which was, what, $136 million?
Yeah, a really substantial miss on the top line. Material.
But then you look at adjusted earnings per share, and they came in at 0.88 cents. That was just a penny shy of the street's dearly an 18-cent consensus.
Right.
So huge gap between that revenue picture and the earnings picture. What was going on there? What caused that?
That gap is definitely stark. And the primary reason that reported JAP revenue was so far off the mark, well, it was a pretty significant hit from a securities sale. Management made a strategic call here. They decided to sell about $266 million worth of investment securities. The thing is, these were only yielding around 1.6%.
Wow, that's low.
Very low. And taking that action resulted in a $60 million pre-tax loss. So that just hammered the reported top line number. It basically masked what was otherwise, pretty steady and strong core profitability.
Okay, so a deliberate strategic move, but one that really changed the look of the quarter on paper. Despite that big hit, were there bright spots in the, let's say, the core banking business?
Oh, absolutely. And this is key. The net interest margin, the NIM, it actually widened by a healthy 13 basis points sequentially. 13 basis points, okay.
Yeah, hitting 3.68%. And on top of that, both loans and deposits, they saw low single-digit growth, kind of steady progress.
Right.
So that really points to a healthy underlying engine, separate from that one-off securities hit.
That's crucial context. Let's really dig into those pivotal financials then, because that difference between reported and adjusted is, well, it's massive. Reported net income was just $2.9 million.
Tiny.
Compared to an adjusted figure of $40.8 million. And then pre-tax, pre-provision net revenue, PTPPNR.
Always a mouthful, that one.
Yeah. It was negative $4.4 million reported versus a pretty robust $58.6 million on an adjusted basis. And you mentioned that $60 million pre-tax loss from the security sale. That's clearly what drove this huge gap.
Exactly. And PTPPNR is so telling here because, it strips out those one-time things and the loan loss provisions, gives you a much cleaner look at the bank's actual underlying earning power from its main operation.
Right, the core engine. That $58.6 million adjusted figure, that really shows a strong, profitable operation kind of humming along beneath all that surface noise. And if you look at net interest income itself, it was actually up 3.5% quarter over quarter and up 8.6% compared to last year, hit $111.4 million.
So NII was strong.
Very strong. And that 13 basis point NIM expansion getting up to 3.68%, that came from a few places. Solid loan growth, like we mentioned. Also, they managed their cost of funds pretty effectively, reducing some higher cost deposits, the non-relationship kind.
Okay.
And, well, there was also an extra day in the quarter, which always helps a bit.
Right, the calendar effect. So the core interest income side, the heart of the bank's profit, looks very healthy. What about non-interest income, another key revenue stream?
Yeah.
Even with that big securities loss factored in, were there good signs there?
Yeah, despite the reported loss because of that trade, the core non-interest income was actually quite strong, came in at $25.8 million.
And how did that compare?
That was up 9% from the prior quarter and up 8% year over year. And that strength was driven mostly by stronger swap fees and also higher mortgage banking revenue.
So diversification helping out there.
Exactly. Shows those other income streams are performing well.
Okay, let's talk expenses. Total non-interest expense was $81.3 million. And you mentioned there were merger and integration costs in there.
That's right, about $2.7 million related to the Southern States merger. And management said those costs are actually expected to peak in Q3.
Okay, so maybe some relief after that. But even with those costs, the adjusted core efficiency ratio, it actually improved quite a bit. Dropped from 59.9% last quarter down to 56.9%. What does that improvement tell us?
Yeah, that's a really crucial point. The efficiency ratio, I mean, it basically tells you how much the bank has to spend to make a dollar of revenue. Lower is better. So improving it from nearly 60% down below 57%, even with those merger costs coming through. That shows management has a really strong focus on keeping expenses in check and, leveraging their operations effectively. That's a great sign for future profitability.
Definitely. Now, switching gears to credit quality, they mentioned they migrated to a new allowance model, a Brigo discounted cash flow model. For our listeners, what does adopting something like Brigo really mean? What kind of granularity and precision does it offer compared to maybe older methods?
It is a bit technical, but it's important. A Brigo DCF model is, it's a more sophisticated, more granular way to forecast potential loan losses.
How so?
Instead of just painting with broad strokes, it lets the bank look at individual loans or, specific pools of loans with much greater precision. It considers the specific cash flows expected from those loans, different future economic scenarios. It just means they can be more accurate, hopefully, in setting aside the right amount of reserves for potential future losses.
And what was the actual impact this quarter?
The model change itself had a net impact of only about $395,000 added to the reserves this quarter. So not huge in itself. The overall provision expense for potential loan losses was $5.3 million.
Okay.
And that was driven mainly by, continued loan growth and also updating their assumptions about the economy, with that model change being just a smaller piece.
And the actual losses, charge-offs?
Yeah, charge-offs remained really low, just 2 basis points. Very good. Now, non-performing loan balances did tick up a bit.
Okay.
But management said this was due to just 3 large credits. Importantly, they stressed these are well secured, and they believe there's negligible loss content there. So it sounds like they're comfortable with the quality of those specific assets, even though they're currently non-performing.
That's reassuring context on the credit front. And, speaking of things hitting the bottom line this quarter, the tax situation was also unique. Is that fair to say?
Yeah, unique is a good word for it.
That $10.7 million benefit seemed, pretty extraordinary. Can you unpack what drove that, and how unusual is something like that for a bank?
It certainly stands out. It was kind of a perfect storm tax-wise. First, because of that big securities loss, their pre-tax income was actually negative. That alone can create a tax benefit.
Right.
But second, and this is the really unusual part, there was a one-time $10.7 million benefit. This related to an old amended tax filing. Basically, the statute of limitations expired on it. So the result was they got $8.7 million in funds return, plus another $2 million in accrued interest that had been set aside. So yeah, definitely not a recurring item. But it provided a pretty significant lift to the bottom line this specific quarter.
Definitely a one-off boost there. Okay, let's shift to the strategic moves. The Southern States merger integration sounded like a huge focus, announced end of March, legally closed within about 90 days.
Pretty quick.
Yeah, and they're targeting full system conversion, rebranding, team integration, all by the end of Q3. That feels incredibly fast.
Yeah.
What is that rapid execution signal for FB Financial?
The speed is genuinely impressive, and it means this deal starts really contributing much faster. It immediately adds scale. Management says it's earnings accretive right away, and it significantly strengthens their position in key cities like Birmingham and Huntsville.
Right, existing markets.
Exactly. But it also expands their footprint into new, pretty attractive growth markets in Georgia and Alabama, especially areas near Metro Atlanta. So it's a very deliberate move into geographies they like.
Makes sense. And that securities restructure strategy we talked about earlier, selling the $256 million of low-yielding bonds, clearly a bold move. Management said they had a dual purpose for the cash. First, redeeming some sub-debt and trust-preferred securities in Q3.
Yep, paying down some higher-cost debt.
And second, keeping capital for future loan growth. They pointed out that new loans they were putting on the books at the end of June had yields over 7%.
Big difference from the 1.6% they sold.
Exactly. They're projecting like a 6% yield pickup with a payback period on that initial loss of less than 4 years. That sounds like a pretty confident bet on where things are headed and their ability to lend.
It absolutely is. This is management basically saying, we'll take a calculated hit right now, short term, to fundamentally reposition our balance sheet for much better earnings down the road.
Right.
Shedding those low-yielding assets, getting ready to put that money to work in loans yielding over 7%. That signals strong confidence in their ability to find good lending opportunities and generate much higher returns. They're optimizing for what they see coming.
A very proactive stance then. And building on that, the CEO, Chris Holmes, He sounded very bullish on the call about the second half of this year, 2025, and into 2026.
He did, yeah. Quite optimistic.
He hit on 3 key areas. The earnings profile, which he sees improving thanks to the merger scale, and that's securities restructure.
Makes sense.
Growth prospects, both organic from hiring good bankers and inorganic, meaning more M&A, and just overall balance sheet, strength, capital, liquidity, credit quality. What's underpinning that confidence, do you think?
It seems to come from having a clear strategy and actually executing on it.
Yeah.
The Southern States deal gives them immediate scale benefits. The securities restructure, like we said, is designed purely to boost future earnings power.
Okay.
Combine that with the fact they keep successfully recruiting talented bankers for organic growth, and they have a strong capital position ready for future deals.
Yeah.
Yeah, you can see why they feel they're set up pretty well.
And he also raised their ambition on the efficiency ratio, targeting the core banking efficiency ratio down into the low 50s by the end of next year, Q4 25.
Yeah, and then even below 50% in 2026.
That sounds pretty aggressive. Is that achievable?
It is aggressive, but they laid out the drivers. A big piece is the cost savings they expect from the Southern States merger. They estimated saving about 25% of Southern States' annual non-interest expenses.
It's substantial.
It really is.
Yeah.
Plus, they mentioned aggressive internal goals within their original FirstBank franchise, too. They clearly see opportunities to streamline things and really leverage that growing scale to become much more efficient.
Okay, shifting focus now onto the balance sheet dynamics more closely. Loan growth came in at 4.2% annualized for the period end. Deposits grew a bit faster, 7.2% annualized. Management's term for this was pedestrian.
Yeah.
Pedestrian.
For our listeners, what does pedestrian growth actually mean in today's banking world? Is that still actually pretty good compared to peers?
That's a great question. In this environment, with higher interest rates, economic uncertainty, a lot of banks are seeing loan and deposit books that are flat or even shrinking slightly.
Right.
So for FBK, pedestrian probably means steady, consistent growth, maybe not blowout numbers, but solid forward progress. It implies they're still finding good opportunities, still taking some market share, even if the overall economy isn't exactly booming.
So relative outperformance, maybe. Probably, yeah. And they did note that some deals got pushed from Q2 into the second half of the year because of those broader economic headwinds. But importantly, things are still moving forward.
And if we drill down into where that loan growth happened, it was concentrated, it seems, in residential mortgages, 1 to 4 family homes, lines of credit. That bucket was up $56 million. And also commercial real estate, the non-owner occupied kind. Those balances were up $45 million. What does that specific concentration tell us about their lending strategy right now?
Well, it shows where they're finding opportunities and perhaps where they feel most comfortable deploying capital. Residential mortgages can be, a relatively lower risk way to build customer relationships.
Sure.
And the focus within CRE on non-owner occupied suggests they have specific expertise or see particular strength in certain market segments or property types there. It's not just growth for growth's sake, it's targeted.
Got it. And on the other side of the balance sheet, deposits. You mentioned they reduced some higher cost ones.
Yeah.
We saw an uptick in non-interest bearing accounts and money market accounts.
Right, the core relationship deposits.
At the same time, broker deposits increased a bit, which they said was for liquidity management. And they deliberately cut those higher cost non-relationship deposits. What's the strategy behind juggling those pieces?
It's really about optimizing their funding mix. The focus is clearly on growing those sticky, lower-cost relationship deposits, checking accounts, money markets tied to real customers. That's the core funding.
Okay.
Using some broker deposits is a common tool just to manage day-to-day liquidity needs. But actively shedding those more expensive transactional non-relationship deposits, that shows real discipline in managing their overall cost of funds efficiently.
Makes sense. And looking ahead, potential for future commercial and industrial loan growth.
Yeah.
You mentioned unfunded commitments.
Yeah, this is interesting. These are lines of credit that businesses have access to but haven't fully drawn down yet.
Right.
Current utilization, they said, is in the mid-30s% range. Before COVID, it was typically higher, maybe low to mid-40s.
So there's unused capacity there.
Exactly. It represents a significant pipeline of potential C&I loan growth that's already committed. If the economy picks up, if businesses get more confident and start investing or needing more working capital, they'll draw on those lines. That translates directly into loan growth and revenue for the bank without needing to originate brand new deals.
A nice potential kicker if things improve.
Okay.
Okay. And briefly, multifamily lending. Sounds like demand has cooled off a bit.
Yeah, they noted it slowed down compared to maybe a year or two ago, partly due to a lot of new apartment supply coming online in some markets.
Okay.
But they still see opportunities there, just maybe more selective now. They're focusing on working with their top-tier experienced developers, even though they've seen some loans pay off recently as projects stabilize or get refinanced.
So still active, but maybe more discerning.
Seems like it, a more normalized market there.
Okay, let's pull back and talk about the investor context. That 43% reported revenue miss. It clearly spooked the market initially. Stock took a noticeable dip.
It did, about 4.7% slide post-earnings, I think.
And it seems like investors really keyed in on that headline miss, maybe worried about execution risk, despite all the positive talk from management about synergies and core strength.
Yeah, the optics weren't great on that reported number.
What's really striking, though, is that other regional bank stocks, their peers, they only slipped modestly that day, which kind of underscores that this was seen as a company-specific issue or maybe a reset for FBK, not some wider sector problem.
That's a really crucial distinction, I think. The market seemed to react to the specific one-off event, that securities loss, and maybe some uncertainty around the near-term merger integration costs. It wasn't broad fear about regional banks,
Right.
which suggests that once the noise from the securities sale and those peak merger costs starts to clear, maybe in Q3 or Q4, the underlying positive trends we talked about, the NIM expansion, the core profitability of those, could allow the market to reevaluate the stock based on its fundamental strengths.
That brings up the whole M&A landscape. Management sounded pretty optimistic about more deals happening in the banking sector generally.
Yeah, seems to be a common theme right now.
And this Southern States deal helps FBK get into that $16-17 billion asset range. That's often seen as a sweet spot for better returns, once banks cross the $10 billion threshold and face tougher regulations.
Right, scale helps absorb those costs.
They said they see significant room to run for more M&A, and they're specifically targeting opportunities in the, $3 billion to $7 billion asset range.
Yeah, with maybe more opportunities down in the $3 billion range being available.
And they also highlighted something interesting, this idea of capitalizing organically on upstream M&A, meaning when bigger banks in their markets merge, they see it as an organic tailwind. What exactly do they mean by that? How does that work?
It's a clever point. When very large banks merge, or even just restructure significantly, there's often disruption.
Sure, happens all the time.
Right. Sometimes talented bankers feel unsettled. Maybe their focus shifts away from certain types of clients, and sometimes good business clients feel underserved or just lost in the shuffle of a mega merger. FBK, positioning itself with a strong balance sheet, but still that community bank feel, they aim to be the natural landing place for those potentially dislodged bankers and clients. So they can pick up talent and business without having to buy an entire bank. It's growth fueled by disruption elsewhere.
An opportunistic, organic growth strategy. That's smart. And feeding into that, they're actively recruiting too. Added 4 new revenue producers in Q2. They see themselves as a right landing place for successful bankers.
Precisely. It shows they're not just relying on buying growth through M&A. They're also focused on building their internal team, recognizing that attracting and retaining good bankers is absolutely key in this business.
And finally, just to reassure on the foundation, capital strength. They mentioned their common equity tier 1 ratio, CET1, is over 12%.
Yeah, very strong.
What does having that strong capital position really allow them to do going forward?
Well, a CET1 over 12% gives them significant flexibility. It means they have plenty of dry powder for future strategic moves. That could be more M&A like they talked about, could be stock buybacks, or just continuing to fund strong organic loan growth. Capital is clearly not going to be a limiting factor for them. They're in a position to be proactive, to be on offense.
Okay, we've covered a lot of ground. The numbers, the strategy, the market reaction. Now let's pivot to our not financial advice segment. This is where we toss around some maybe outrageous but plausible trade ideas based on everything we've just discussed.
The fun part.
Exactly. But first, the crucial disclaimer. We are not investment advisors. This is not financial advice. These are strictly ideas for you to consider, think about, and definitely research further on your own. Do your own due diligence.
Absolutely. Just food for thought.
All right. My first idea, I'm calling it the integration arbitrage play. The thesis here is pretty simple. FBK shares took that hit, slid about 4.7%, mostly because of that ugly reported revenue miss, which we know stemmed from the one-time securities sale.
Right, the noisy number.
But management spent a lot of time detailing the rapid integration of Southern states, projecting significant cost saves, Remember that 25% of SSBK's non-interest expense. And they expect immediate accretion to earnings. All that implies significant future earnings power that the market seems to be kind of ignoring right now, lost in the Q2 noise.
Just a play.
The play is to consider a long position in FBK. You're betting that as that Southern States integration really takes hold in Q3 and beyond, as those cost savings materialize, and as that efficiency ratio starts moving down towards the low 50s, the market will eventually re-rate the stock. They'll start focusing on the strong core profitability and the improved strategic position rather than just that one-off hit from Q2. It's basically a bet on management's operational execution and realizing those synergies.
Okay, betting on the execution follow-through. I like it. My idea connects to the broader consolidation theme we discussed, I'll call it. The regional consolidation short on the fringe.
Ooh, interesting. Shorting little guys.
Kind of. Look, FBK management was pretty explicit. Their ideal size is maybe $20 billion. They see a lot of room to run for M&A, especially targeting those $7 billion banks. Plus, they mentioned that organic tailwind from disruption at even larger banks.
Right, the pressure is building.
Exactly. All this suggests increasing competitive pressure and likely more consolidation across that whole Mid-South regional banking sector. So the play here is identify some of the smaller, maybe less efficient or less strategically positioned regional banks within FBK's main operating footprint, Mid-South, Georgia, Alabama.
Well, they might be vulnerable.
Precisely. Banks that maybe lack the scale FBK now has or don't have a clear M&A playbook or aren't driving efficiency as hard, you'd consider a short position or maybe just an underweight position, perhaps on a basket of these potentially vulnerable players.
What's the end game there?
You're anticipating one of two things. Either they continue to lose ground competitively, their performance erodes relative to the stronger players like FBK, or they eventually become sort of distressed acquisition targets, where the deal terms might offer limited upside for their existing shareholders. It's basically a bet on the strong getting stronger and consolidating the sector, potentially at the expense of the weaker fringe players.
Two interesting angles there.
Yeah.
Okay, let's wrap this up. So what does this all mean for you, the listener? We've unpacked FB Financial's Q2. It was clearly a quarter marked by some big strategic moves, that rapid consolidation with Southern States, and that transformative but initially costly securities sale.
Yeah, a lot going on. And while that headline revenue number looked, frankly, pretty challenging, the underlying story, when you dig in, it really speaks to strong core performance, that expanding net interest margin, and a management team that sounds very confident about future growth and efficiency, especially now bolstered by that swift merger integration.
So the key question, really, for you as a sophisticated investor is this: are those short-term headwinds, particularly that big one-time hit from selling the securities, are they maybe obscuring the significant long-term strategic value here?
Right. Is the market getting caught up in the noise of that one quarter, missing the potential from the Southern States merger and the company's broader growth plans? Are they seeing the forest or just focused on, one particular tree that got hit by lightning this quarter?
A great way to frame it. And as always, please remember the information we provide here is purely for educational and informational purposes. It should definitely not be considered financial advice.
Please do your own homework.
We absolutely encourage you to do your own due diligence, consider all these factors and how they fit into your own investment strategies. Join us next time on The Deep Dive for more earnings insights.